Now, here is Ticky Fullerton on Your Money.
Hello, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Well, tonight we're going hard on Hayne. Coming up, key industry responses from the Financial Services Council CEO Sally and ABA CEO Anna Bligh, and of course NAB CEO Andrew Thorburn. But first, it is above all the senior executives, the CEOs and chairmen of our big four banks and the AMP who have been called to account. As much was said by Commissioner Hayne in his opening remarks of his report. And so it was all the more remarkable that Kenneth Hayne singled out just one bank chair, Ken Henry, and his chief executive, Andrew Thorburn. One can only imagine the shock at NAB's Burke Street HQ as the news broke after the market closed on Monday. No big bankers were allowed in the lockup, and Thorburn's team worked late into the night, no doubt absorbing the Hayne shirt fronting. Having heard from both the CEO, Mr Thorburn, and the chair, Dr Henry, I am not as confident as I would wish to be that the lessons of the past have been learned, Kenneth Hayne said. Overnight, top banking analyst Brian Johnson, in previous years an NAB buy guy, you'd have to say, had written in his notes to clients, management change at NAB is likely as both CEO Andrew Thorburn and Chairman Ken Henry were specifically signalled out as not being willing to, quote, accept the necessary responsibility for deciding for itself what is the right thing to do. Brian Johnson finished with a buy recommendation again on the basis that NAB last night was cheap. Well, by this morning, Andrew Thorburn was back from extended leave and fronting the media. Our exclusive TV interview coming up. But it is interesting how the bank leaders themselves have come out of this and their strategies. So neither Westpac's chairman Lindsay Maxted nor ANZ chair David Gonski were, of course, called before Kenneth Hayne. Catherine Livingstone, the CBA chair, got a grilling from Rowena Orr, who almost enjoyed, it seemed, giving the governance expert a lesson on board minute keeping. Westpac CEO Brian Hartzer has been pretty outspoken recently on the property market, whilst ANZ CEO Shane Elliott found himself selling copies of the big issue on the day that Hayne came down. People say there's a big sigh of relief in banking, and just look at the share prices, we'll look at them in a minute, but leadership teams are now bracing for the regulators. Three of the four big banks, NAB, CBA and ANZ, have all been referred to the regulators in Hayne's report. Westpac has already got matters running with regulators. The blunt message from Kenneth Hayne to the regulators is find your teeth and head to court. The era of first compromise through enforceable undertakings is pretty much over. We just don't know whether criminal charges will be laid against individuals. So frustrating as it is for Joe Public, it ain't over yet. And I can assure everyone out there that the boardrooms of the big four banks and of AMP, there's no high-fiving going on in there, I can tell you. Yes, well, all eyes were on the big banks again today after the long-awaited final report of the Banking Royal Commission was released. After the closing bell yesterday, well, the report has made 76 recommendations to improve the banking, super and financial sectors. Commissioner Kenneth Hayne has also made at least 20 civil and criminal referrals to APRA and ASIC, as I was mentioning, involving companies including CBA, NAB, ANZ, AMP and IOOF. Looking at the bank share prices, the big four and AMP going relatively unscathed, actually bouncing higher in today's trade. You can see AMP up 10%, ANZ rising over 6%, CBA up over 4%, NAB rising over 3%, and Westpac surging 6.5%. I say, really AMP recovering from its recent slide, a very big recovery there. Then, of course, there was that stinging rebuke to National Australia Bank, its chairman Ken Henry and chief executive Andrew Thorburn. So what does Andrew Thorburn have to make of all of this? Well, he did front the media this morning. I spoke with the NAB CEO a little earlier.
We have made a number of mistakes in recent years. We've acknowledged them. And we've also said that the mistakes we've made, we haven't fixed fast enough. I think that was my testimony, and I think Ken's as well. And also, I think we've made a number of changes to start to put customers first again, holding our standard variable rate, not closing branches in drought-affected areas, not charging default interest, all those things.
You did hold the rate. It's come up a bit now. Yeah, but Kenneth Hayne, if I can just say, it says that you haven't learned the lessons of the past. You don't know what the right thing to do is. You said that's pretty hard to read. He's thrown the book at you, and you disagree with it.
Well, Ticky, what I'd say is, there are 76 recommendations and over 1,000 pages. I think it's a very good report. It's going to bring major change, which is needed in our profession and our sector, certainly since the FSI and maybe going back as far as the Wallace inquiry. So the substance of it, I think, is very sound. I agree that when you read the reference to myself and Ken Henry, our chairman, I found that upsetting and hard to read. I did feel it was harsh. I respect the Commissioner's view, that he stated that's his view. I don't share it because I feel that we are acknowledging, we are making decisions, actions that are proving that we want to rebuild trust with customers. And as a leader, look, I'm very honoured to be a leader, and especially at NAB, and I feel that the way he's describing me is the polar opposite of what I want to be and what I am and the sort of change I'm leading inside the company.
Indeed, Ken Hayne would appear to disagree with both you. And, this is extraordinary to single out Ken Henry, your chairman, the former head of Treasury, the man who's the chair of the bank that presumably sets the culture from the top, the man who was called out of touch when he was on the stand in the Commission. He too is pushing back today. He says that he is, quote, disappointed that Kenneth Hayne thought he seemed unwilling to accept criticism of how the board dealt with the issues raised by the Commission. Can you really change culture if you're not contrite from the get-go?
Well, Ticky, I think we have been contrite. I think this is where we need to be clear. If you go back and look at what I've said and Ken Henry has said, including in the Commission and other statements we've said we have made mistakes, we are sorry, we want to fix them. That we're making new decisions. Some of those decisions I mentioned about interest rates and default interest rates and offset accounts and branch closures, I think they're the decisions we're making which show that we're listening and acting differently. So I think we are being contrite and acting differently.
You've got full confidence in your chairman, Ken Henry, do you? You don't feel he's let you down?
No. Look, Ken Henry, Ken's made his own statement today, Ken Henry. We can't get our Kens mixed up. Ken Henry has, you can read that statement, but Ken Henry has said, look, I did acknowledge that the board did not take fast enough action, and I regret that. That's my words, not his, but that's sort of what he was saying. But the Ken Henry I know and that I work with every day has integrity, has values, puts customers first, lives in a small town in Australia, has always thought long term and done what's right for Australia. That's the Ken Henry I know, not the Ken Henry I read about in the Ken Hayne report.
And Andrew Thorburn, NAB is named in the final report as being referred to the regulators. Have you had legal advice about any criminal charges against you or any other NAB executives?
No, we have not, Ticky. So that is a detail that we don't know yet. Clearly, there are a number of issues that we have acknowledged. We've let down our customers and let down the community, and we are dealing with the regulator on those. So the reference here to other referrals, we don't know the details of that yet. But what I have said is, obviously, if we need to be accountable for those, we will be, and we'll work through those and deal with those constructively.
So NAB is, I think, the first bank to be taken to court over the fee for no service scandal. Penalties estimated by ASIC as perhaps over $1 billion. Now, the blunt message from Kenneth Hayne is that regulators should be tougher. They should be using the court system. This is a new world. How do you think this case and indeed other cases are going to go for the National Australia Bank?
Oh, look, we don't know, Ticky. I think we'll just have to be professional and constructive and work through them. You'd obviously have to talk to the regulators because in the report there was reference to regulators and how they needed to change, so I think you'd have to talk to them. My job is to make sure that we cooperate, we abide by the law, that we work constructively with regulators, and where we make mistakes that we're held to account, and that's what we'll do.
Andrew Thorburn, look, you're known as a good bloke, people who know you. You're coming back from a long service leave early to deal with these issues. A question I have to ask you is around your own judgment. I mean, why is it that a CEO of one of the big four banks, you know, with all this going on, with the Kenneth report, you failed the REM report, the REM report in December, you've got massive restructuring changes, you've got this ASIC action. Was that the right decision? Why on earth did you decide to take extended leave?
Well, Ticky, I think the bigger picture here is our bank has a clear strategy. We have a very competent management team. We've laid out to the market what we're doing and we're implementing that. And I think I've got the absolute support of our leadership group to implement those things. It's not just me, it's crucial. Well, the CEO is crucial to that, but I've got a very competent team and we've got hundreds of leaders who are mobilised around our strategy to be better for our customers.
But on reflection, was it not the right decision to take such long leave?
Well, just let me finish. So the second thing is that I and all our leaders and leaders in corporate Australia, it's demanding. You need energy, you need a break, you have a life outside the company. I mean, I've got a marriage, I've got children, I've got elderly parents. They're the people who I want to spend some time with. And I don't think it's unreasonable that, particularly as I've been in the bank 14 years and you build up long service leave, that I do take that. I think that is important for mental and physical health and to lead in a sustainable long way. And I want a role model to people inside the company that that's okay to do. Now, I think, to your point, the CEO of a big bank, it's always going to be open to criticism if you take extended leave. I mean, I raised this a year ago with our chairman and the board. I said when the Royal Commission report comes out, I'll come back. And obviously I've cancelled my leave as effective last night. I'm back. But I think it's a bit unfair to think that a CEO can't take leave that is due for their own physical and mental health when they've laid out a plan and they've got an army of very good leaders who are carrying out that strategy.
Yeah, finally, look, there's all sorts of speculation, obviously, potentially, that you will be staying on with Ken Henry to deal with all the flack and maybe get a cleaner skin in, perhaps, you know, a man of the people like Mike Baird to take over straight after that. Now, I look at Brian Johnson at CLSA. He doubts you and Ken Henry can survive this. He said in his notes, will you be there for the midterm and the full year results this year? And what are you going to do about your relationship with customers?
Well, relationship with customers, I think if you look at all the things we've done in the last couple of years and the actions we've taken, I think our customers are increasingly becoming front and centre again, which as a banker for 30 years, I feel that's overdue. On my future, look, I'm committed, I'm determined, I believe in what we're doing. I believe a leader should be resilient. I've cancelled my leave. I'm talking with our people. I'm talking with investors. I'm talking with you to try to communicate that I do know what the plan should be and that I'm committed to carrying it through. I've never been more determined to see this through, Ticky. I'm even more determined now to do it, to show that we are doing the right things and we can achieve success. So that's my commitment. There's a lot of things I can't control. That I can, and that's what I'm working on.
Andrew Thorburn, you are talking to me, and we do very much appreciate it the day after the Commission to get your direct response. Thank you very much for joining us. Well, let's unpack that interview with Your Money Chief Business Reporter Leo Shanahan, who was in the lockup in Canberra yesterday. He joins me live at the desk now. Leo, there's, as Andrew Thorburn, as he says, he's back, he's talking, he's back from leave. What did you think?
Well, I think he's tying himself in knots a bit over this leave issue, and I think it was always going to be a bit fraught coming back from the leave to be front and centre of the response and then go back on to leave. Now, at the time I defended him. I said, look, I can understand why perhaps he needs this leave. We live in a society where we say people shouldn't be burnt out, people shouldn't suffer from mental health problems, etc. If
well,
they're
he did actually say, you know, I'm due for my own physical and mental health.
But then he's now cancelled the leave. So
well, this is after being fished out by Hayne.
Yes,
you know,
but what did they think was going to happen after the Royal Commission?
Well, probably not quite that, would they?
Well, I think it was a good chance they would be singled out. It was the worst evidence given by any of the chief executives, and I mean, particularly his chairman let him down, worse than his evidence. Ken Henry's evidence was particularly bad. But I think that, yeah, they were well and truly one of the major targets as far as the big four banks go of the Henry Review, and it was never going to be prettier. You can't predict it, but I don't think it was ever going to be good for them, was it?
Right. To your point about all the different things you know that were going on and his need for leave, one of the things I didn't bring up in that interview, of course, is that he's got this action running that he's caught up in as well, which is the fraud action. Tell us a bit about that.
Well, there's this ongoing investigation, among other things. So we've got the ASIC action, we've got the fallout from the Royal Commission, possible referrals from that, but there's also this criminal investigation into the centre of his office, and we're not accusing him of any wrongdoing, but his former Chief of Staff, Rosemary Rogers, is well and truly a target of that fraud and bribery investigation. So,
but I mean, when he talks about he's got a wife, he's got a family, la la la. I mean, that EA and that relationship between a CEO and an EA, it is an extraordinarily important one, and talking about breach of trust, for that to have gone pear-shaped, if some of the suggestions are correct, that would have put a huge amount of pressure on the CEO. That failure of trust there.
Definitely, and especially if he's being asked to cooperate with the investigation, as they've said they will if asked. So obviously there's a huge amount of pressure on him. But going back to this leave issue, I think the problem is that there's a lack of consistency around it, defending it on the one hand and then saying, well, actually I'm cancelling the leave, saying perhaps admitting that it was a bit of a mistake. That I don't think is the major issue, of course, his leave or otherwise, but the fact that they were singled out by Hayne does bring into question their future. I think Ken Henry and him are looking at a period perhaps where I don't think there'll be any resignation from either of them, and I don't think the board will demand that. I think you might be looking at more of a staged model where when CBA was really in trouble in the last 18 months, when Ian Narev stepped down, said, I'll step down in 6 months, and then the chairman said, I'll step down in 6 months. So you had this kind of staged replacement of people at the top rather than kind of mass migration from the top role. And also you'd be burning, if Mike Baird, for instance, went in there tomorrow, I mean, he'd be there in this highly defensive position. There's being asked to speak on behalf of things he had no real involvement in. Yeah,
well, he'd have to be doing a Matt Comyn, wouldn't he, really?
Yeah, and I mean, but Matt Comyn was head of the retail bank while a lot of this stuff was going on. There's an argument that you get the complete clean skin in there and maybe that helps. I don't think that will help them at this point. And the banks, look, the bank is doing well today, and it will probably continue to do well. All
the banks have done very well, thank you, and AMP. Now, one thing that lots of people were disappointed about, no heads on stakes or anything like that. But that wasn't what Hayne was about. These referrals and the toughening up of regulators, I mean, that's the next chapter, is it not?
Yes, and I think, look, I mean, it's obviously up to Hayne the manner in which he refers, and it should be said it's not the role of the Royal Commission to prosecute people, and that's never a Royal Commission's role. But that being said, I think AMP's performance today was partly a reflection of there being no direct referrals, because we have seen Royal Commissions make direct referrals in the past, but he said there will be referrals, and AMP was one of those, but not that naming names, they should be charged for X, and that was really the worst case nightmare scenario for AMP and the other banks, as well as not going after AMP's business model in vertical integration. Now, whilst there's been changes made to the way in which financial planners obviously have to operate, statements of independence, so you have to say specifically if there is any conflict, what that conflict is. Mortgage brokers, of course, will suffer in the next 3 years, and their trailing commissions are a goner. But as I've said before, a lot of the banks have gotten rid of this vertical integration themselves, AMP not so, because their business model's a lot more reliant on it. So I think the market has said, look, no charges, no getting rid of vertical integration. And what does that mean, number 3? Well, they could be still a viable takeover target. And I think that's also playing into this today.
Fascinating. Leah Shanahan, thanks for all that. After the break, we'll get a reaction from the financial services industry to Hayne's recommendations.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, let's dive into some of Commissioner Hayne's recommendations in more detail now. We've seen a few major recommendations for the superannuation and insurance sectors, so starting with super. And Hayne has put out a total of 9 recommendations there. He's recommending the hawking of super products through bank branches be banned, shake-up of the default super system, with superannuants only ever defaulted into one fund. Another big one, a recommendation that the law be changed to prevent funds from offering employers incentives in exchange for becoming a nominated fund. Think Quest Super and that entertainment budget. There was also the suggestion of the strengthening of existing laws, a call for more action from the regulators and a ban on the deduction of advice fees from My Super accounts. Switching to insurance, and Hayne is recommending commissions on insurance products be either limited or abolished altogether. He's also recommending a shake-up of the duties of insurers to customers and the strengthening of regulations governing insurers. Well, joining me to discuss all of this and the industry reaction to these recommendations, Financial Services Council CEO Sally Loane at the desk. Sally, how was it for you, Hayne?
Hi, Ticky.
Hello.
Quite a big, massive report, a lot of implications for my members, superannuation funds, obviously life insurers, advice licensees, right across the board.
Can I start with AMP? Because, I mean, there it is, up 10% today. Presumably, a big relief for the market that Hayne has not recommended an end to vertical integration or a complete blowing up of its business model.
Yes, absolutely. And it's really good to see the share price of AMP up today. That's fantastic. I think one of the things that the whole market was really concerned about was that vertical integration would be banned under Commissioner Hayne. But
a lot of it's gone, of course.
Yes, a lot of it has gone anyway, and a lot of the banks decided to sell their wealth businesses long before the Royal Commission. But I think vertical integration is throughout every business across financial services, whether you're a big industry fund. Industry funds have, some of them have advice businesses, in life insurance. So there's vertical integration across the spectrum. And I think the issue for all financial institutions is how do you manage those conflicts?
Well, what has Kenneth Hayne had to say about what these advisors need to do? And what's that going to do to the business?
Yeah, look, I think we talked about this to our members today, right across the board, and basically a lot of the things that Commissioner Hayne has had to say are things that we've been looking at now for quite some time.
But they go to the heart of this is conflict of interest, isn't it?
Yes, they do. And I think when you mentioned there before with life insurance and commissions, there's no commissions now left for advisors. All the grandfathering will go, and that's a good thing. We certainly support that. The issue with life insurance, though, I think is quite different. We've only just got a new set of legislation that's only been in for a year, and that is reducing the high upfront commissions for life insurers. That's been done. We tackled that 4 years ago when we had the independent Trowbridge report into life insurance.
Yes.
And out of that came an end to high upfront commissions, and our life insurance code of practice came out of that as well.
But what is going to happen now generally to financial advisors who they've got to actually declare, don't they, if they're at all conflicted?
Yes, they do.
How's that going to impact business?
Yeah. Look, they will have to declare that they're independent. They'll have to tell consumers a whole lot of other things. Now, most advisors, I think, are saying that's okay, but we do have to watch the cost of all this because they're going to be hit with a lot of compliance. A new compliance regime.
And that's true, is it? That's real?
Well, we don't want to, I think, price advice out of the market because people need good advisors. They're already going through a massive change under the professionalisation standards, which are well underway.
Well, this was one of the concerns if an end to vertical integration had happened. People were worried about that. It's a concern now with mortgage brokers as well, with the possible changes. But given that vertical integration is staying, will it really lead to more costs? on the financial advisory?
I think that's what we've got to watch. I just don't think we know that yet. The devil will be in the detail in terms of how much more compliance they have to undergo.
But it certainly shouldn't be an excuse to ratchet up fees. Otherwise, we're back where we started, aren't we?
No, we want transparency. Everything that's come out of the Royal Commission should, in the end, lead to better value, better outcomes for consumers. That's all. That's what everybody wants.
Quickly, onto the banking codes and your codes, which I'm a bit confused. They're going into the law, or ASIC has jurisdiction over the codes? Does that mean
we have
the
life code? The Life Insurance Code of Practice at the moment. It is enforceable by the Life Code Compliance Committee, an independent group which is managed by AFCA. Now, that is enforceable. We have just gone through a massive process of...
But what does this mean? What is this new level?
The new level means that if ASIC approves our code, that means there is going to be an ASIC governance over the code. Now, what that means for the current enforcement regime, we just don't know.
And will it put this code into law? Would you be breaking the law if you didn't abide by it?
It may be if it's in a contract, and I think that's going to be part of what we have to look at down the road.
Well,
but we absolutely, we've said right from the start that our goal is to have our code enforced by ASIC.
All right, let's look at industry super now, because you guys were surpassed by industry super in terms of fund under management about halfway through last year. The industry super over retail funds, but this one default that individuals will only default once. Presumably that has an impact right across industry funds and retail funds.
I think it's going to have an enormous effect. 80% of Australians default. Now, the problem that the Productivity Commission found, that every time those 80% of people changed jobs, they were defaulted into another fund, which meant that some people had up to 10 funds.
So you've got all these tiny funds. This is what Karen Chester was going on about.
Yes.
PC.
10 million zombie super funds that are eaten up by billions of dollars worth of fees and insurance fees. Now, that is a travesty. How did we allow this waste to occur? So the fact that Commissioner Hayne has actually pulled this out of the Productivity Commission report and said that is a good reform, it will lead to better consumer outcomes. Now, if people just have one fund, and by the way, it's not absolutely compulsory, you're not wedded to it for life, you can change if you want to change into a better fund, it will affect those 80% of people who default, and most people default into what their employer chooses.
Interesting, the politics of this, that actually Kenneth Hayne didn't go big on the super industry, really, did he? But he just pulled it in. So his level of scrutiny and recommendations in other areas, this is a rather different approach, I would suggest. What about his recommendation around the offering employers incentives, super funds doing that, for entertainment, that sort of thing?
Well,
relationship.
What's that?
And what would that do to the relationship between unions and funds, do you think?
Look, I'm not sure, and I don't know much about how widespread it is, but he said it has to stop because it's a conflict. And what he said, he's gone right through a lot of parts of financial services and said where there are conflicts, it needs to stop.
Sally Loane, we'll enjoy you coming back and having a chat on how everything's going through the year. Thanks very much for coming in.
Thanks, Ticky.
After the break, my one-on-one with CEO of the Australian Banking Association, Anna Bligh, next.
This is Ticky on Your Money, covering the big business stories.
Going back now to the banks and have a look at what's been recommended from Commissioner Kenneth Hayne there. We've seen a shake-up to the financial advice sector, but no real crackdown of vertical integration for banks, which was expected. Hayne has recommended amending the banking code, a crackdown on commissions, banking culture and remuneration also under scrutiny, with remuneration to be overlooked and standards to be revised. There will also be a review into APRA and the establishment of a new oversight body for both APRA and ASIC. So how will the banks be impacted by these recommendations? Because, of course, both sides of government have said that they will accept all of them if elected, except possibly one on behalf of the coalition around mortgage broking. Now, well, for the banking industry's response, I spoke with CEO of the Australian Banking Association, Anna Bligh, just a little earlier. Anna Bligh, well, AMP Chairman David Murray welcomed this report as actionable, didn't blow up his business model. Bank shares are up. The public, though, clearly not satisfied. Where to now?
What we saw delivered yesterday by Commissioner Hayne, I think, was a thorough recipe for reform and change across the sector. There's 76 recommendations, which in total amount to, I think, the biggest overhaul that banking and finance has seen in Australia in its history.
Well, when you say big overhaul, 75 of the 76 obviously going through, what impact will that actually have to your members?
These are very significant changes, and not only in banks but also in insurance, financial advice, superannuation, some of which banks also have an involvement in. So this is a complete overhaul, and there are many, many new protections for customers, many new entitlements for customers, and it does represent a very big shift, I think, away from a sales culture to a service culture.
Well, interestingly, Hayne didn't go as far as ending vertical integration. It means businesses like Westpac can keep their wealth. Do you see in any way, though, that bank operations vertically integrated being changed?
We've already seen banks have a very good hard look at the businesses that they're in and the businesses they want to operate. And a number of banks have now decided to get out of businesses that aren't about core banking. You'll hear from a lot of bankers that what they want to do at the moment is get back to basics, get the core right, make sure that their basic banking product.
But the no hawking provisions the no hawking recommendations, will that change culture, do you think, in places where banks are still offering products, other products?
Well, I think if you look right across Commissioner Hayne's report, he talks a lot about a sales culture versus a service culture. And I think these are the sorts of provisions that will actually change not only how people do business, it will start to change the culture that has underpinned some of the way these businesses have run in the past. And that's a good example, that no hawking, a really good example of a new protection for customers that will make a lot of difference.
What about the area of super, and in particular the Board of Trustees, and this recommendation that it's members first? Now, how will that change the boardroom?
Well, I think many people would have assumed that that was the case already, but I think the power of making it explicit and putting it beyond any doubt will definitely change the conversation around boardroom tables.
And different in terms of outcome too.
What I think you'll see is increasingly customer at the heart, at the beginning, the middle and the end of every conversation around the board table, because these duties will fall individually on trustees and directors, and that I think is going to be a very focusing set of rules for people in those positions.
So accountability more clear, I suppose. On top of that, you've got a very blunt message coming now down from Commissioner Hayne to regulators on the fact that they need to use the court system more directly. Now, your action task force that with all the bank representatives, presumably that is going to be very much high in mind as a different sort of relationship that you're going to have with the regulators.
Well, the Commissioner he identified a number of things that he thought really underlined all of the problems that he identified. And one of those was accountability, making sure that when things go wrong, when an individual or an institution or a company does the wrong thing, that they are held accountable. Not only that the customer be remediated, which is critically important, but that there is accountability. And I think we are going to, I don't think the regulators have been left in any doubt about the expectations that not only the Commissioner came to the issue with, but increasingly I think what the public expects.
So more court and enforceable undertakings, as we've seen with Commonwealth Financial Planning this week. It does seem extraordinary, by the way, that they didn't manage, Commonwealth Bank didn't manage to get their house in order on that front.
Which I think goes to the complexity of some of the issues they're dealing with, but I don't think that the regulators are under any doubt about what's expected of them, and I do expect that they'll be having conversations right now internally about the recommendations of the report, the conclusions that the Commissioner has drawn, and that we will see a shift, and that will change the relationships, and I think possibly for the better.
And Kenneth Hayne, I seem to remember early on in one of the financial planning sessions, one of his more acerbic comments was he notes how much banks are quick to spend and invest on stuff that makes money, but they seem very reluctant to do it in the area of compliance. Is that going to change?
That's already changed in the last 18 months to 2 years. I think in every bank, large and small, very significant new investments in compliance. As you would be aware from market announcements, most of those banks are also involved in quite large remediation programs, and that's meant bringing on new staff to make sure that those programs are done as quickly and effectively as possible. I think the other thing the Commission really drew attention to is recognising that, yes, sometimes complaints are identified, fixed and remediated, but the amount of time it takes can often make things very difficult for customers, and that means allocation of more resources, which banks have already made announcements about.
Andrew Bligh, you say banks have learned the lesson, they're determined to learn the lesson. Now, Kenneth Hayne, remarkably singled out two senior executives, the chairman and the chief executive of National Australia Bank, Ken Henry, Andrew Thorburn, for not having learned the lesson.
Well, I think in my experience, it's hard to form a full character judgment of someone from the basis of one interview with them, which is really all the Commissioner was able to do in his terms of reference. All I can talk about is the Ken Henry and the Andrew Thorburn that I know, and I've been in rooms with them when big reforms and big changes are being contemplated, and more often than not they're the first ones to put up their hands.
Yeah.
And
so look, I'm curious, should he could have chosen the combination of, say, Ian Narev and Catherine Livingstone, former CEO and current chair of Commonwealth Bank, to give a dressing down without coffee to, but he chose not to. He chose specifically Ken Henry, former head of the Treasury after all. Now, you say he can't be judged really on one interview in the Royal Commission. You speak to the banking community, obviously have been over the last 24 hours. What are they saying? I mean, could this be personal?
Well, I think that's a matter for Commissioner Hayne, and I don't think it's going to help the situation for me to speculate. All I can say is that in my personal experience, both of these are men of integrity, and they are people ready, willing and able to jump when they need to make changes. And I think that's, we need that. What Australians need right now is the leadership of their banks, the leadership of the finance sector to pick up this report, embrace it and be willing to not just implement it, but understand that implementation might take a bit of pain and a lot of change. And I'm very confident in the conversations I've had with all of those senior leaders, including those two, that they are more than up for this. They want to restore their reputation as quickly as they possibly can.
Yeah. Do you think they'll stay? Do you think Andrew Thorburn will stay to deliver his full-year results in November?
Well, I would fully expect that.
A lot of talk around possible changes to mortgage broking. Now, this is something that the government is resisting. Labor, who the polls suggest will be in May, will be accepting it, though. What do you think of this? People say it's likely to benefit, make the big four banks even stronger, and question whether it really will benefit the customer, who will have to pay more.
Well, banks are acutely aware of how important the mortgage broker channel is. Close to 60% of all mortgages in this country are done through the mortgage channel, and for a number of banks it's much higher than that. It is particularly critical to smaller banks and to online banks, and it's that level of competition that is, I think, really important for customers.
So would you support the change recommended by Kenneth Hayne?
Well, I should firstly just say the government has actually accepted quite a bit of Kenneth Hayne's recommendation. There's only one part that they've said they need to look at further and hold a review on. So there is certainly some very big changes being suggested or being recommended.
Do you support that bit that they're having trouble with, which is very much around whether a customer should actually pay the broker directly and get an independent, conflict-free view?
Well, I think it's certainly the case, as the Commissioner outlined, that would eliminate all of the conflict, but it's a very big shift, and the industry, to be frank, is still getting its head around what would this actually mean in terms of lending, borrowing and the housing market. So we don't want to rush to judgment, and yes, banks are just saying, let's exercise caution here because there's actually a lot at stake. Significant competition in the sector. Consumers clearly want to use mortgage brokers and find them convenient and enjoy the sort of support they get through the process. we'd want to be very careful about, I think, anything that threatens the viability of the industry. But I think there is an onus now on the industry, mortgage brokers and the government, and I note that one of the recommendations is to set up a Treasury-led working party. Yes. We've all got an obligation to come around the table and find something that will work. If it's not going to be the old model, how do we make a new model work? Because, you know, doing something that collapses the mortgage broking industry is not a great outcome for customers, and it's not a great outcome for competition. And
I was speaking to Kate Carnell, the small business Ombudsman, and she was very disappointed, I have to say, in some of Kenneth Haynes' recommendations, or lack thereof, particularly leaving the self-regulations to the big banks in terms of this 30 days and how the banks can manipulate it, and also whereas farmers get an independent valuation of their land if distressed, small businesses aren't going to get an independent valuation of their assets.
Well, I think the Commissioner, he took a lot of evidence on small business and he took a lot of submissions, and the overwhelming majority of those submissions, in fact I think all of them that I'm aware of, cautioned him against over-regulating that sector because of the importance of small business and the need for them to be, you know, flexible, and for banks to be flexible in lending to them is to the whole economy. That doesn't mean that anything goes, and the new banking code contains a whole chapter for the first time ever on small business, and does extend a raft of new entitlements and protections. On this question of the 30 days, I should say that we have been in discussions with the Ombudsman, Kate Carnell. The provisions that allow in reasonable circumstances are there for a reason, and they go directly to the bank's legal responsibilities under money laundering laws. But we have indicated if there's a better way of phrasing it that's more encouraging, of course we'd look at that. We want small business to thrive.
Finally, Anna, I asked this of you before, but when you signed on, you were not signing up for a bank levy, and you certainly weren't signing up for the Royal Commission. Now you've got it through, you're going to stay?
Absolutely. What we got yesterday was a roadmap for reform, and a roadmap of what I think is a roadmap to build the kind of banking system that Australians want. And that's a pretty interesting and exciting challenge to be part of. And as I said before, I've got every confidence that's what the sector wants to build. You know, they want people to be able to trust the strength of their banks and to trust the integrity and ethics of their banks. And if we can pull that off, it's a really important thing.
OK, well, you've got an election campaign to get through first. Anna Bligh, thank you very much for joining us. And after the break, we'll get a greater industry reaction to Commissioner Haynes' final recommendations. My big banking panel with Lonsec Chair Jeff Bresnahan, board member Ian Knox, and Deloitte's Dr. Pradeep Philip come up next.
Now, back to Ticky.
Welcome back now to close this big post-Royal Commission show. It's worth reaching out beyond to those directly impacted by the Royal Commission. Here to give their industry response to Commissioner Haynes' recommendations, pleased to welcome Jeff Bresnahan, Chair of Lonsec, Ian Knox, who is on the board at Lonsec, used to run Seal Corp, for those who remember, and Dr. Pradeep Philip, partner at Deloitte Access Economics. Gentlemen, great to have you here. Ian, let's start with you, financial advice. How do you think these recommendations are filtering out to those at the grassroots in financial advice?
Yep. Well, Ticky, I think firstly the whole report was incredibly well balanced, and the content of it had a good build-up. Advice has been bashed over the last number of years, and the information that's come out, this is really just reinforcing most of those things.
Well, we had FOFA and... Yeah.
And FOFA, interesting enough, not many people look at this, but FOFA, when it was brought in by the previous government, actually accelerated vertical integration because it brought additional costs into the industry.
Well, I know David Murray sort of presumably sighing with relief because that says that the AMP business model, and it's what, back up 10% today, is okay.
Yeah. Well, I think from the financial advice fraternity, the big issue, the big picture is it's moving from what was an industry to a profession. Along that journey, the report reinforces and accelerates some of the professional standards that will go with that. Some of the consequences of that is the de-shackling of past history, which involves getting rid of commission payments, any form of engagement with a client where you're receiving money where you're not seeing the client. So The biggest one that really came through, which I think when reading the report, where the report focuses heavily on fee for no service, which originated out of the institutional world with the banks originally engaging with clients and then not re-meeting them. Interestingly enough, the private advisory firms in the marketplace, they can't afford to do that, so they have a much deeper relationship with their clients from day one. But the consequence of the biggest change there is that forthwith the changes are that they have to meet with their clients yearly in advance, advise those clients what the fees will be,
yes,
and outline the services they provide. The second thing is grandfathering of all payments will be
phased out,
which is no surprise. But the consequence of that for businesses is they will no longer be able to engage with 400 or 500 clients. If you think about that, you can see all those people and you've got to actually deal with them.
Well, let me bring in Pradeep here. I mean, you've looked at competition in many sections of the economy. What do you think this change will do?
Ticky, can I just make one point? It was never, ever right to take money from someone and not provide a service.
Yeah, look, I think we can all agree on that one.
That's right, and that's one of the key things of Hayne's report and the whole show of the Royal Commission, that there were activity that was going on that just wasn't right under any circumstances. And competition pressures have been important. We saw the emergence of the mortgage brokers market essentially because some of the large institutions weren't taking care of individuals, and it was making it hard for individuals to navigate the home loan market and find something that was good for them. But there was this presumption that the mortgage brokers worked for that consumer. And now we discover that actually, because of lack of transparency, payment structures at the back end has meant that brokers
They didn't work for the consumer, they were working for the banks.
Absolutely.
Yeah.
But not always necessarily a bad thing. And I think what it allowed was for smaller and regional banks to get a foothold in this market. And suddenly, for the home loan market, we got competition. And that forced the big banks to also compete and innovate and reduce their costs.
So what do you think of this proposed unwinding, really getting the borrower to actually pay a fee to get a loan or to look at a loan? What is that going to do to the mortgage broking market?
So look, Hayne tries to solve the problem of transparency by saying, actually let the borrower pay so that the broker knows who their master is. But the unintended consequence of that could well be that the small and regional banks who got a foothold in the marketplace because of mortgage brokers suddenly lose out to the big banks.
And the unintended consequences, Ian, of the changes to financial advice is it's going to be very hard for any operations which have hundreds of clients to actually deliver on what Hayne wants. And what's that going to do for cost and access?
What it's going to do is increase the cost base because of the additional regulations, force acceleration of use of technology and how you engage with people. That'll be probably one of the outcomes of that happening.
Yes.
But essentially a trimming down of financial planning businesses, a change in their profitability.
Yeah. Well, won't robo-advice come to the rescue here?
I doubt it, because robo has a role to play, but all of the iterations of robo-advice to date within Australia are focused on investment issues.
Yeah.
And advice is all about strategy and giving people advice in terms of wealth creation, tax, meeting goals, etc. Hard to do at this stage from what we've seen on robo.
All right, let me bring in Jeff here, and another area of the Royal Commission, which was superannuation. Some quite interesting recommendations, and particularly in the boardroom with the trustees.
Yeah, and one of his key recommendations was that any trustee director cannot hold any other role or office in a related party. Now that may have intended consequences, I think, and the interesting part there is where you've got vertically integrated funds, where they're also the related party administrator, an investment manager, and insurer. They now have to get pushed out to the market. So there's a few winners here, and some of the big winners are companies like Link Administration and Mercer and those guys that are out there waiting for this to happen. It has technically been a requirement of trustees to do this historically, but it doesn't occur.
Yeah.
So,
well, and it's technically been the requirement that they put their members first.
Yes.
But this is now really going to put it first.
Absolutely. When you've got no commonality between directors, between a supplier and the trustee directors.
So you talked about the winners. Who are the losers?
I think in this case, at the moment, when I look at the way they've said about advice fees and things like that, I actually think the retail superannuation funds are the ones that will struggle. So what they've done over the last probably 10 years is to create low-cost products to compete with the not-for-profit sector,
yes,
which is fine, but they've also distributed them through the bank networks.
Yes.
Now, Mr Hayne was quite clear that you are now no longer allowed to hawk. In other words, tellers are not allowed to hawk that product. So they have no distribution because the advisors aren't going to distribute them because they have no incentive to.
And what about the nexus between industry funds and unions, say, which the government is always harping on about?
I'm not sure there's been any comment on that in the whole report, and I think it's largely irrelevant. What it will force boards to do is to continue that progression up the expertise or level of professionalism and the balances that are on those boards at the moment. Yeah. We're talking about $100 billion plus funds going forward. You need a lot of professionalism on them.
Right. One thing that's clearly happened is that the regulators now have more teeth. It's going to be quite a different playing field, I would suggest. Ian, how do you think this is going to impact?
Well, I think by giving the regulator additional teeth, as you'd call it, and looking for much greater accountability at a regulatory level, having regard for that, I think that's enabled the ability to not have to dismantle the vertical integration. So basically saying, this isn't about regulations in the past, this is all about behaviour. They've used the word culture in the past, but fundamentally it is corporation profits first through the institutions. That has clearly had a resounding alarm bell go off. I think it would have been a really draconian move to have vertical integration brought into Australia. It doesn't happen anywhere else in the world.
Yes.
And now what we're saying is there's going to be accountability, a really strong accountability, and it goes from a single person advice practice right up to the biggest bank in the country.
Well, yes. Now, Pradeep, let me ask you about what this means for our bank and financial services leaders, the CEOs and the chairman.
Well, can I say, I think Commissioner Hayne has essentially told the sector that the free lunch is over. Basically, don't do the wrong thing just because you can get away with it. Do the right thing.
But he hasn't gone and capped fees or suggested capping fees like Labor might suggest.
In part, I think the art of Hayne has been to recognise that black letter law doesn't fix culture. Right? So he's sent a very strong message through the forum of the Royal Commission, the case studies, he's exposed all of those things to say, leaders, take charge about doing the right thing. The second thing he does do, though, he provides prescriptions to say, make the consumer the centre of your organisational design and of your product and your behaviour, and set your incentives for profit and other motives, not just for the short run, but for the sustainable long run, so that there is no conflict between being careful and caring for your consumer and your bottom line.
Wouldn't that be good? All right, well, gentlemen, we are right out of time, but I'd like to thank you very much all for coming in. Really new issues raised there, so thanks a lot. That's all for the show tonight. Tomorrow night, it is CBA's half-yearly results. We'll go through the details with CEO Matt Comyn. Until then, thanks for your company.